Okay, picking up on where we left off with quant or quack, we kind of ended it basically demonstrating that the smarter the guy, pretty much the stupider the guy. Trading has nothing to do really with intellectual prowess, academic accomplishments. It really doesn't matter. It really doesn't. There are some rules that make this thing go round, and it's only a couple of rules. It's not a lot. The first rule is capitalization. You got to be well capitalized to operate in the markets. You also have to approach trading as a business and not gambling at a casino. The markets are not a casino. The markets were not ever intended to be a casino. However, gamblers who are attracted to risk come to the markets, thus gambling. Gamblers have also applied gaming theory to trading, thinking that it will give them an edge, only to be wrong. You see, the market is made up of individuals, and individuals have different mood swings and different feelings and reasons for doing what they're doing. And you don't know what the other guy's rationale is for doing what he's doing. You got people that are hedging. You got people that are long-term buy and hold investing. You got people who are scalping and day trading, trying to take out a few ticks here and there. Everyone has a different motivation and reason for why they're in the market. But at the end of the day, the number one goal is greed. Everyone is here to make money and trying to figure out where they can make another buck. So with that said, if it's not based on intellectual prowess, if it's not based on academic achievements, then why is it that the mainstream media keeps touting the foolishness which we call high-frequency trading? What is high-frequency trading and how does it affect you, a retail investor? You want to know the real hard facts, the real honest truth, or would you rather be lied to because you want to hear something that feels good? Well, I'm going to give you the hard truth. The hard truth is this. High-frequency trading has nothing to do with you. It does not affect you one way or another. Only you affect you. You lose money in the market. All right? Only you do. No one's losing the money for you. You're losing the money. Even when the Dow crashed 1,000 points on May the 6th, do you know that had nothing to do with you? I don't care if you were invested in the market or not. What did that have to do with you? Nothing. Here's why. See, I don't just put things out here and then I don't back it up and prove it. You better believe that if I'm going to bring something to bear, I can back it up. And I know what I'm talking about. And I can prove what I'm saying. So I'm going to prove it to you. Who remembers my Goldman Sachs video that I made on the 5th or May 3rd or May 4th? Anyone? If you have not watched that video, go ahead and pull up the Vulcan report for that, for Goldman Sachs, for the week of May the 6th, and you'll see what I'm talking about. I specifically warned that the volatility indicators were going berserk and that a huge volatile session was about to occur and that an enormous breakout or breakdown was going to happen. Do you remember that? Do you also remember me saying that I took profit on positions prior to May the 6th? I could have held on for May the 6th. I could have held on one extra day, but I didn't. What would have happened had I held on? I would have made a ton of more money that day. I would have picked up several hundred pips instead of the 150 pips I pulled out of the Forex. But I didn't do that. Greed kills. Remember what I always tell you. Bulls make money, bears make money, but what? Pigs get slaughtered. So I went ahead and got out. If it don't feel right, I don't do it. I got out. Did I miss something? No. I was safe. I didn't lose money on May the 6th. How many people can say that? I made money because I took my profits and I got out of the market prior to May the 6th. So, back to what I was saying. Does May the 6th hurt you? The high-frequency trading hurt you on May the 6th. It didn't have to. Whatever they do in the market is irrelevant. Why do you think I put out my spreadsheet 24 hours in advance before the market opens? Why do you think I do that? Because I don't care what the market does the next day. I have a trading plan already in place. Whether the market crashes or rallies, it's irrelevant. I have a trading plan to handle that. That's why I can confidently put my orders in the market when the market's closed. I can put them in just prior to the market's opening. Doesn't matter, man. All right, let me start from the beginning, because some of you, I'm losing some of you. You're not tracking with me. You remember me telling you how I've been giving little hints and pieces about exactly who I am and what my background is. If I just came out and told you, I'd probably get into a lot of trouble. And it would probably do a lot more damage than good. So I can only drop little hints and clues and things here and there. I also have to be careful in what I say, because a lot of the things that I say, some of which is extremely classified, and so that's why I said in my prior video, I do not wish to commit suicide. I do not wish to have any harm come to me or my family. I like to live. I want to live. So I watch what I say. I would like to be able to really just take the gloves off and say a lot of things, but I can't. And there are a lot of reasons why I can't. One of those reasons is I like to continue breathing. And one of the reasons why I'm able to continue to do so is because I know what I can say and what I can't say. That's why sometimes I can drop names and I can give a lot of details, other times I cannot. Reason being is because I've done things, I've worked on things, I've seen things, and I can't say anything. Because they would know that I'm the only other person who knows, and obviously if I'm saying it, then there you go, put one and two together. But the things I can say to you is mind-blowing enough, so I think we'll just leave it at that. I have to get back to mining, mining the nest, so to speak. Markets open, so I try not to make too many videos during the day when the markets are open, because I gotta do what I gotta do. But let me just put this out here, and then we're gonna move on to the next chapter in this No Snakes Alive series. Let me just say this. There are a lot of things that have been going on for a long time, and the public is just now getting whiff of it. High frequency trading is not new. There have always been ways to do what you needed to do in the markets. All right, let me just run it down for you really fast. Okay, back in the back prior to 1980, the big thing was technical analysis. Everybody wanted to learn technical analysis and technical indicators. Okay, you didn't have an IBM ThinkPad, you didn't have a Hewlett-Packard laptop, you didn't have these computing capabilities, so everything was done by hand. Dudes used point and figure charts and things like that, and would have to calculate charts and draw them on huge pieces of construction paper and stuff, and everything had to be calculated by hand. All right, I came into the business having to calculate everything by hand. That's how I learned. Okay, yes, I said it. I calculated moving averages and stochastic oscillators and all those wonderful things that you've heard about. I had to do it by hand on paper. It would take me more than 2 hours every morning just to do my calculations on just one security. Now you try tracking several securities that way. All right, and let me know what's up. So that's how I started, doing everything by hand, man. That's what's up. That's how you had to do it. You had to straight up do it by hand if you wanted to do it at all. So in the 80s, that's when the computer thing really started to take off. And those of you who can recall the very first Apple computer for the desktop computer that you could go to the store and buy came out. And in the early 80s, that allowed people to go in and do what they needed to do and start learning how to do things on the computer and write codes and programs. And it was fun, and it took your market analysis to another level. So then everyone started taking everything they did by hand and programming in the computer and let the computer do it. So it cut down on time and everything. Well, after right around the mid-late 80s, right around the 1987 crash, is when a lot of computers were actually involved in 1987. And you started seeing that institutions using computers and stuff like that. So that's where it really started. That's where it really reared its ugly head, was in the crash of '87. And then from there, when the '90s came around, we still didn't have online trading. That didn't come around until like the end of the '90s, like '99, 2000. Actually, not even '99. I take that back. It was like 2000, 2001, because I remember I was one of the few people who worked on the first prototype, which was called the PAT system. And that was something that they brought over from Europe here to the U.S. And I was one of the first people that got to work on that platform. I think I may have said too much, so I'll leave it there. That's all I can say on that. Let's see what else. So what happened was it was very important to begin to hire people to work on these computer programs who knew all the different computer language, and if you had a guy who could do these things, then you would pay him to go in and write these codes and program these things for you. And then it didn't stop there. Then you had the thing where the quants really started to take off in the mid '90s, and you have this thing where you're in a bull market now, a raging bull market where everyone wins. Everyone became an expert. Whenever there's a bull market, everyone's an expert. So what do? You go and you hire these sharp kids out of MIT and all these other Ivy League schools. You pay them $400,000 a year, and they come in and they become your analyst, okay? And they write computer code for you. That's what their job is, to get all your computers networking and working together and automating your approach and your strategies. So that's what these people did. So a lot of the big hedge funds and institutions and stuff had these guys come in, pay them $100,000 a year to write code for them. And then you had the analysts who got paid $400,000 a year. And the difference between a quant and an analyst at the time was the analysts, their job all day was to meet with the companies and everything, and know everything that was going on for a particular company. And they did a few other things, and I can't go into too much detail on that. And the quant was more your PhD guy, your computer guy who would come in and he would just write all the programs and the codes. He didn't do any trading. He just wrote the codes, okay? Now, the birth of the prop desk, because the prop desk took off and everything, and you had all these guys sitting here just kind of like monitoring what the computer was doing. They weren't sitting there coming up with the ideas. They were just, their job was, they were paid to sit in front of the screen all day and monitor and make sure that what's supposed to happen is happening, okay? So that's how most prop desks work anyway. Some prop desks would allow those individuals who excel to be able to have a little bit more leeway and use some of their own ideas and things like that. If it worked, then that's cool. But for the most part, everyone had a limitation and a task and a specific thing they